start with our next one here. So if Dave and Damon would come on up, we will get into the process of how to value shops a bit more in detail than the first buyers panel, and then really some focus on how to maximize that value. I think hopefully that's one of the most important takeaways from today, is things that you all can do today or starting soon, even if, as was put into the survey, the majority of you are in this sort of 2 to 5 year window before you're going to exit. And that's actually a perfect time to really start digging in deep. So here we have Damon. Hey, Damon, how's it going?
It's going great, Paul. How are you today?
I'm doing very well. Very well. Thanks.
Awesome.
And hopefully Dave is coming on here shortly as well.
I show that I'm on.
I don't see your video. Your video on, Dave? There we go.
There we go.
Now you are. Perfect. Awesome.
Right.
Well, I'll let you guys first introduce yourselves, and then we'll sort of dig into some of the questions. So, Damon, why don't you go first?
All right. Well, my name is Damon Posalka, as you can tell, co-founder of Exit Your Way, and just get a little bit about my background. I started out as a farm kid on a big family farm in South Dakota. Went to school for engineering. Started actually while I was in college in a tool room drawing injected molds. So that was my, other than the kind of things that I got into on the farm of building, rebuilding, fixing, was my real forbearance, or whatever you want to call it, my entrance into manufacturing. I continued on after that to run different kinds of manufacturing companies after I've done a bit of engineering. After I got out of school, and ultimately was building and running manufacturing companies. And some of the last companies that I ran for investment owners were CNC machining companies based around aerospace and medical and some other industries. So in 2016 or 15, I formed Exit Your Way with my partner, Andrew Cross. And we've been helping business owners, primarily in the last 3 years of ownership, really get their businesses prepared and sold.
All right. And Dave, tell us a bit about yourself.
Great. I'm a tool and die maker by trade. I've been in and around the trades my entire life. Got into the industry in the early 90s. Started my own company in 1996. And I was actually been part of owning 9 different companies since then, since from 96 to now. Love machining. I love machine theory, just the art of making, whether it's molds, dies, orthopedic parts, aerospace parts. I took a liking to both Swiss machining and 5-axis milling. But really, it's a great game of business. The things that I've learned over the years, and I've had some awesome people come alongside me and invest in me. And my life mission is to just invest in others and help them learn what I know. And then our business mission is to impact lives through improving business performance. So as Damon deals with companies on right when more of a broker dealing with companies right as they're getting ready to sell, our company is all about developing those companies and putting systems in place and coming alongside owners and educating them what all the systems they need to have to have a successful exit. So that's all about me.
All right. Great, incredibly perfect backgrounds for this session, which is why we picked you guys. So let's get into the first things you guys want to share here.
Awesome. Damon, you want to start and I'll finish up?
Yeah. So we're going to talk about a little bit about the beginning with the end in mind, and really what that means as you prepare for the end of your business, whether you're selling or succeeding. You really need to understand what red zone thinking you're really going to use in the end, because in those last 3 years of running your business, there's going to be some different things that you want to do. And really, as you think about it, both from like my perspective, and you'll see that more as Dave and I go along, I'm going to concentrate on things like the financial aspects and what the buyers are looking for and those kind of things. And as Dave talks about the other aspects of the business, how it should be set up and things like that, you're really going to want to understand where you're going in this last period and how you're going to get there.
Awesome. That's awesome. It's one of the wonderful things that Covey took us a task with. Always think about the end, because This is going to cause you to make different decisions as you set forth your business and you go in a direction, whether you're going to buy that machine or hire that person or develop that level of management. You got to remember what your end game is and when that is, whether it's 1 year, 3 years, 5, 10 plus years. It's critical for all your goal setting is to always think about the end in mind, having the end in mind.
Yeah, I think that's a great point, Dave. And as we look at this too, from my perspective and from the owner's perspective, you really need to understand what that means in terms of value. Okay, how much money do I need terminal value when I'm either selling or succeeding my business? And how much money do I need to make between now and then too? Because it can be a combination of the two. But as much as this is about your business, is about your financial planning too. If you're leaving a business to retire, and even if you're succeeding in business, that business has to be able to give you the money you need beyond to do what you want after. So
right, exactly. And when you oftentimes, ladies and gentlemen, they start a business and they're like, what do I want from my company? You know, we all have families and we really want to take care of our families. We want to retire a certain way, whether it's Darcy on a pirate ship, which I thought that was awesome, by the way.
Yeah.
Whether it's starting a software company or whether it's building a legacy for your family.
Yeah.
What is that dollar figure? What's gonna give you that? So when you set that up, it's okay. Let's build a plan to get there. Whatever that dollar figure is, whether it's $1 million or $100 million. I'm working with a private equity company right now that we're tasked with helping them spend $1.8 billion in machine shops. So with our systems, we have a lot of private equity companies that come to us and say, we love what you're doing. What do we do? And then companies like Damon come in and help with that transaction. But it's so important that you know exactly what you want so you can set that up and then have somebody come alongside you to build that plan and how to get there for sure. So, I mean, this is a great slide. Everyone needs to be building something scalable and sustainable. It can't be revolved around one person. One of the things I learned early in business, and that was quite the stressor for me, is I felt like I needed to do everything. The next person wouldn't get it done the way I would, and it was so hard to hand that off to somebody. So we build 5 specific plans. You got sales. How do you make that sustainable? You have a CRM or something like HubSpot. You have marketing, which is the 4 Ps: place, promotion, product, and price. You know, you have to have some kind of marketing plan. What market you're going to be in, financial, but you have to have some kind of software, QuickBooks or Sage, you know, right? So there's so many things. Operations management. What's your management succession? You know, what are you training and how are you bringing those people on board? And and I don't care who it is, but have a trusted advisor, somebody you lean on and trust that can lean into you, right? Right, Damon?
Yeah, that's for sure, because really this is where your mindset needs to change and start to think about who is going to be taking over my company. Well, and I talk universally about selling or succeeding, because succeeding a business is, if you don't know it, it's just as difficult as selling a business from a lot of aspects, because if your kids or relatives don't want the business, it's just as bad as you can't get it sold, right? So you really need to understand what they're going to be looking for in terms of, you know, what are your profitability? Is it moving on? Is it when you walk out, or you or other owners walk out of the business? I mean, Paul, you guys had a great example, several owners leaving at once. It's you got to really understand how that business is going to really go after and be a sustainable business, as Dave was talking about. So there's a lot of different things that you need to focus on, putting that buyer's perspective in mind as you do it. So, and Dave, you know a lot about that as going along and really talking about owner involvement and sustainability and those other things.
Thanks a lot, Damon. One thing I want to bolt on, I talked about operations management. That month over month, the one thing I like about ProShop is you have a lot of modules, a lot of data you can look at month over month and how do we do last month. And it's so critical to have that information and to be sustainable, right? So, you know, what are buyers looking for? I just, what do you need to focus on? Let's talk about that if you want to go on to the next couple slides here. One thing I love business. I love machine shops. And as we come across our clients, a lot of owners are really stuck in working in what we call the whirlwind. You have jobs that are coming late. You have a customer that's being a little demanding. You have an employee that's causing some opportunities for growth, I'll say, right? So I have stuff. So owner involvement, you have to have a cast of characters, that support your company while you're away. We had a client that he spent 6 months local working in a shop and 6 months in Florida, and 6 months while he was away, he was looking at all his metrics, how he was doing in managing and just measuring the business. And it was going really, really well. But that owner was able to step out of the business and the business was able to run. And the new owner, when you sell, when somebody buys your company, they don't want to step in and have to run all the minutia. They got to keep it rolling, right? You need a team that drives the business and delivers on your expectations, right? No one person can be scalable. So the transition needs to be rewarded. I go back to the sustainability systems there. The systems I'm talking about is I drive to ERP. I really do. You can't do much without ERP. The SQDP, what I call SQDIP model, the safety, you have to have a safety metric, right? Or quality, what's your scrap and your rework, how many dollars you throwing out the door because things aren't being, what kind of errors we have, delivery, what's your on-time delivery to your customer, what's your productivity, what's your efficiency, your earned hours versus quoted machine hours, what's your utilization on equipment, how do you make a decision on buying a piece of equipment if you don't have some kind of utilization? And the new owners, they want to step in and see these metrics so they know how to drive the business. And you have to have that information to engage on a month-over-month basis so you make good decisions. And bench strength, we can talk about that all day long. But I won't, if people that know me know I can talk a bit, right, Damon and Paul? But I have a huge passion for this. But bench strength is two things. You got managers, your second layer managers, and you got technology. What kind of, if you're running, if you're trying to compete with a CNC lathe and all you have is a Clausing, a 1976 Clausing manual lathe, you're not going to be competitive. You're not going to make any money. So your talent in front of your machines and your leadership team is so critical as far as your bench strength. And you have to become an employer of choice to be able to attract that talent these days. It's really tough. But if you have a good team and they're buying into it and you're leaning into them and teaching them, and you have data that kind of backs up the progress and you're sharing that and celebrating that with your team, you really bring people alongside and develop that bench strength. And you do that through a lot of education. You educate, you train, you share. You got something you're thinking about?
Yeah,
something?
I'll just interject that we, since there were three of us in our shop, we obviously worked in the business all the time, right? Kelsey was head of operations, Darcy was finance and admin, and I was sales and marketing. But when we started having this thought that we were going to sell, we intentionally hired people to replace ourselves. We hired, a general manager to replace Kelsey. We brought in, a really strong bookkeeper to handle all the book sides of things. We hired someone to help. We hired an outside salesperson, and an estimator, right? So all three of us were almost completely eliminated out of the daily operations, and that just made it much less scary for the buyers when there was a good, solid management team. That bench strength was there, and they all got retained. And
it's amazing. And the things that you can do for the bench strength once the business grows and you pass it on to the next buyer, they want to reward those people too, because they want to keep retaining them and staying away from attrition is so critical, right?
Yeah. That general manager is still there. 7 years later. Right?
That's a great transition right there. That says a lot.
Yeah,
now,
it does.
The last one is the market you're in. You got to talk about this. Don't underestimate your market. You have a passion for what you're building. You have a passion for the market you serve, whether there's a difference between making an automotive part and making a surgical robotics part. That market means something as far as your valuation. It could be space, it could be automation, high technology, it could be all kinds of different things, but pay attention to what you invest in. Like, you don't really want to go buy 10 machines to build VCR parts, right? Probably not going to work out very good for you. So take a look at what's happening in the market. Look at the stock market. Look at what tracks or what trends are happening with new technologies. What do you want to go after? I remember I had a couple guys tell me, you're never going to get in the medical device space. It's just never going to happen. It took me about a year, and I was doing about $4 million in medical device. Don't tell, if you have an owner with a lot of grit, you'll find your way there, right? So if you don't have a specific market, have a specific niche, something that you make that no one else does, something you do better than the next person. You don't want to be a general shop. And if you do, find something you do better than somebody else, because that market's going to give you more EBITDA points, which Damon will talk about later, right? So in short, owner involvement, make sure you have a team. Sustainability, make sure you have good systems. I love to push the Pro Shop button because we love the software because it gives you good metrics and good reports for that. Make sure you do whatever it takes to foster good bench strength and get in the market that's not just good for you, but good for the potential next buyer. And I'm sure Damon has some great stuff to contribute here.
Yeah, thanks, Dave. I'm soaking it in really because, man, you're such a source of knowledge for this, and I just love hearing you speak because it's dovetailing into what we're talking about now. When you start to look at, okay, you know, what are buyers looking for? Yeah, man, it's just good stuff. It's good stuff because buyers, they don't have 20 years in your business and getting used to all the risks, and you know, you've weathered some hard times, right? They're coming in from a different perspective now. And really what they're looking for is they want consistency. They want repeatability. They want, that's what they're looking for because they are investing a lot of money. You over time have built an investment up in your business. Mm-hmm. Typically you may have started small or whatever and built it up. But what they're looking at is they're going to put millions of dollars into your business. And they really need to understand that that investment is going to pay off the way they want. So they want profitability with growth potential going forward. Buyers don't want to come into a business and buy a business that's stagnant and really want to be able to understand that they're growing that value. And then when they, on top of that, they want like recurring revenue. Now, in some industries, this is harder than others, right? Because, some industries don't put out long-term contracts. But if you're in an industry that'll put out a year-long contract, or even sometimes like businesses, I used to be in the aerospace and specifically in the high-end defense, they would put out multi-year contracts for stuff. And that was like the panacea. If you can get a multi-year contract and you've got pre-negotiated material prices and a bunch of other junk, that you might not get to that point. But the more you can get to that and predict that recurring revenue every year, the more your buyers will flock to your company. Because remember, they don't understand. They didn't get comfortable with that one customer over 20 years or something like that, being a good customer and always being there. They're walking in off the street, so to speak, and going to be plopping down the money and taking it from there. And recurring revenue is really, really one of the things that they look at. Even if you can get the contracts that are you're going to produce everything that we order on this product is better than nothing. Mm-hmm. So, and going into the last part of this, we can go to the next one here, the value growth potential. Now, this is something that we hear every single time we talk to a business. I don't care what kind of business it is. Everybody has growth potential. Now, if you want to get paid for some of that, you have to be realizing this. And when we're working with clients, as Dave and I talked in the last couple of years, and I know Dave does this all the way through, you got to be executing on that potential. Because I can sit here with the machine shop and say, as the example Dave said, we should be in the medical space, and there's tons of opportunity in the medical space. Well, that's true. But from a buyer's perspective, they are not going to pay you a dime for that. To them, it's just like saying, "Hey, I should bet on the Vikings this weekend," or something like that. It's a could be, maybe kind of deal, right? And so what you got to do with these kind of things, when you look at the value growth potential, and this is where you can really, really, really hook buyers in, is get your business on a nice growth trajectory and have some be down that path of ways with that growth. If you're if you're going into medical, it's a great potential. Get started in the medical. Get it showing that it's growing month over month, quarter over quarter, however the rate it goes. But don't go to the level where it flattens out. Keep it on that uphill climb, and then get your business sold in that area of the growth curve, because the buyer sees that you're already executing on that growth, and it makes them more anxious to get in while the growth is there. And then when you look beyond that, have your next stage of growth kind of figured out in your mind and go, we figured this out, 2 years ago, we're executing on that now. And then, Q1 next year, Q2 next year, we're moving down the road into automotive because we just took over the medical where we wanted to be, and we're moving into another industry or another customer or whatever you got, because the buyers don't understand where the growth is coming. Again, they haven't had that time in that business, and you need to be able to articulate that to them. Even if they're an investment buyer that's not going to run your business, you still need to be able to sell it, because when we talk back to profitability and all these other things, the value of your business is largely determined by the profitability today and the growth potential tomorrow. So
you couldn't have said it better. That's awesome stuff, Dave. We see some businesses, some of these guys that'll come in and say, we want a business with this golden customer. And if they're on their ASL and they do that, boy, I've seen companies go 17 times EBITDA for being in a specific customer or having a specific niche and something what they do. But if you don't have a trend going up, you're 100% right, Damon. It doesn't happen.
Yeah. Go ahead, Paul. Sorry.
I think we also heard that from Justin earlier, right? He was looking at the shop. They had a really profitable year, but losses on either side of it, right? So they clearly didn't have probably the sales-driven process and the diversity of clients, and possibly even multiple value streams of, prototype and production and engineering or their own product line or whatever, right? So very, very volatile, which is scary for buyers, right?
Typically, tell me, Damon, when you're doing a transaction, typically the buyers want to see 3 solid years of past history, right?
Yeah, they will. The value is typically generated on the last year. And specifically, if you've got some really good growth going on, you can get a little bit of that upside of the growth in the value, but it is the last 3 years. And Paul, you made a great example, because if you've got a loss year and you've got even a making year and a loss year again, that year you made money doesn't do you any good. I mean, it really, and especially this is the other thing. If your sales are going down and your profitability is going down, even if you're profitable, it makes it really difficult to sell a business on the way down. And that's why I can't stress enough that once you get in that growth curve, and we're all just programmed to do this, try to stay in and make that extra buck here or there. And when you're in the end, this is red zone thinking again. You got to get out while the getting's good. Because you don't want to have a 2008 or whatever, 2001 when the in the aerospace industry, like where I was involved, went to heck, and then you got to wait 3-4 years, and nobody wants that. And that's why it is so key to get into that growth potential and get into it, 60-75% and be on the market at that point.
Absolutely.
Yeah, that's what Darcy shared as well in the last presentation. Don't wait till things are tough and you're just tired of it and want to get out. Get out when it's good. Absolutely.
Well, because if you don't want it, nobody else does, right? That's just like, it's like people come to us and they go, oh, I'm just burnt out. I gotta get out. Well, if you're burnt out, why is that attractive to the next person? Now, and this is really key for succeeding a business too, because if your kids have seen you just bust your butt forever and being not liking what you do, how do you ever expect them to get into it? It's got to be set up right. And people like Dave, they're going to help them get them set up right, so it's an attractive business for your family or the next buyer.
Thanks, Damon. I'll tell you what, you couldn't have said it better, because when someone's really excited, we have a client recently that's so excited, man, things are going so good. And me and my business partner, like, it's time to take the money off the table. You are in the last 3 years, you've quadrupled your value, all this stuff. It's time but I'm having so much fun. I'm like, perfect. The next guy's going to have that fun too. Let's pass this along. And you know what the next guy wanted? Hey, we want that owner to stick with us for 2 years. And we're going to really pay him well for it. Give him some good incentives. And it all worked out really well. But he decided to get out while the getting's good. And you're 100% right.
Yeah, I tell you what, the business transaction market is littered with people that wanted to stay that extra 6 months.
Yep.
And then they can't do it. Something happens inevitably. So,
And
I,
markets have their own cycle,
yeah,
irrespective of your business, right? There are
Mhm.
times where multiples are just higher than they are at
yeah,
other times.
yeah,
Absolutely.
And keeping an eye on that is also important.
yeah,
Now we'll talk about danger zones, right? Is that next?
Yes,
yeah.
that's up. I think if someone owns the trademark to Skeletons in the Closet, we owe them a bunch of money because
Yeah.
almost every person in this whole day has talked about Skeletons in the Closet.
I'll let you start, Damon, and I'll
Okay. Okay. Well, this thing you've talked about before, the previous presentation, this presentation, we've touched on it a bit. There are things buyers look at concentration risk, and this is over the top. It's customer concentration, vendor concentration, employee concentration. And I will talk about that a little bit more, because as an owner, if I'm growing up and I just had a client last year that they had, I don't know, it's like 75% of their business was in one customer. Now, in some industries, I mean, if you're a tier one supplier to somebody, that might be inevitable, might be part of your business. But if you can take that customer concentration and diversify a little bit, or diversify among divisions in the same company, and that's what we did with the client I'm talking about. They were tied into a big oil field company, and it was like, yes, you were doing business with, this company, but we're doing visions across the globe and in multiple divisions, and there's all different kinds of things happening. That is not nearly as bad as if I'm doing business with Dave, and Dave and I are doing 75% of our business together. Well, a buyer looks at that, and that's a no-go. And not just because the buyer themselves, but they've probably promised to their investors, if it's an investor buyer, that they are not going to invest in companies that have customer concentration risk. So it's not just somebody deciding differently. When you look at the investment buying community, there are regulations, well, I shouldn't say regulations. There are stipulations around them being able to get the money to invest in companies to buy, that they have to go. So if you've got too much customer concentration, try to mitigate that. And Dave can talk about that a little bit more. And then too, with employees, again, I had a client last year. They had 4 owners, all active in the business, and Paul articulated it so well. They had not thought about that ahead of time, and we had to do the exact same thing, Paul. We went in, and it was the CEO, it was their head of integration, it was another general manager in an area, and then we had to hire those people, get them in, get them trained, and actually get them down the road a while before we could sell the company, because you couldn't just do it tomorrow and then the next day try to sell, because every buyer is going to come in and look at that and go, well, they haven't been battle tested yet. They got to go through a year or something like that to do it. So
for sure.
These are things that as you're moving through your business, and Dave was talking about the bench strength and other things, you really need to identify early, because it's not something you can turn around in 60, 90 days. It takes a while to do it. And then the last but not least, I was actually, when you talk about employees or vendors, the vendors was the last thing that I found was really interesting. Talking to an investment buyer a few weeks ago, they were mentioning they were looking at a company to acquire, and it had one vendor that was a critical vendor to this company, but that vendor was actually a competitor in the market to the company that used them. I was wondering, how the heck does it work? And I wasn't under NDA, so I couldn't share details, but he just expressed that. So you got to look on all 3 sides: the customer concentration, employee concentration, and vendor concentration, to make sure that you've got plenty of options for that new owner.
I'll tell you what, Damon, I've seen deals fall through on all of those. I saw a company that was so profitable with one client or one customer, and they had a phenomenal opportunity to sell something, and they just couldn't, because they were 90% one client. Because one client took from $1 million to $20 million in business, and they're like, you're just holding on to their pants trying to grow that fast, right? So, and vendor concentration will sneak up on you, especially if you're outvending something specialized, right? But as far as where I'm at on the ops side, we meet a lot of business owners that say, hey, can we see the last 3 years of financials? Can we see how you're doing? And they hand us their tax returns. I'm like, whoa. I need to see your month over month financials with projections. And did you hit what you expected to hit? Show me how you're doing. And it's the accounting is kind of messy, and what does this tell you? Or they're not sorted out right. So we help put that together. And then you have operations, your efficiencies, and all those metrics that you can pull out of your ERP system. Are you measuring it? Where were you last year? Where were you last month? And as funny as it is, how's your lease or your rent priced? Are you way above fair market value? Are they buying something with a bill for your building that's way too big? Look at that. And then if you're a machine shop, this is something couldn't be more critical. Environmental risk. What are you doing with your coolant? What are you doing with your oil?
Yep.
You have to control the environmental risk, because that's something they do their phase 1 or phase 3.
Yep.
They're going to get down and they're going to ask all those questions. Just when you think they're done asking questions, then all the other questions start, right? So, due diligence is no joke. You need to be prepared, and you need to have a good partner beside you when you go through that. Somebody like Damon, when you're going through that process, they know what they're going to ask for. They're the intermediary between the buyer and you, and making sure that that's right. And you need to be well protected. But man, skeletons will bite you. And there's something else, an aging workforce. I'm a tool and die maker. I'm probably one of the younger tool and die makers that I know. Most of my comrades that have a tool and die card are well older than I am. And when you walk into a shop with 18 retirement age people and 2 younger people to fill those spots, they're like, boy, this business is only going to run a couple of years, and then I got to backfill everybody. So you have to be thinking about that. And the guys with a lot of knowledge, they want to pass it on. They want their legacy to live on. So you need to really take care of that. But you're right, Paul. You can't, or I think Darcy said it, or Darcy or Kelsey, don't wait till the last conversation to pull the skeletons out. The more transparent you are, the deal will go better.
Yeah.
Yeah.
Like if you were saying on environmental, like if you're used to dumping your used whey oil down the drain in the back, and they start asking, where's the contract with your waste disposal service? And you're like, I don't have a contract for that. Well, where's your oil going? You don't have a good answer. That kind of stuff. They will ask those questions.
Oh yeah.
No, you don't. No. Right? Oh, goodness gracious. And bolt onto that, you have to have good emotional intelligence. Damon and I could camp right here.
Yeah.
We could finish this show and probably talk well into the night on this. Selling your company is like putting one of your close family members up for adoption. And Paul, or anybody ever that sells something, will tell you that the emotional attachment you have to your business is so much bigger than what you think it is. So you have to come to grips early with that. You have to make sure the deal is a win-win. Damon's going to talk about red light, green light, right? And it's so critical. But that emotional intelligence to understand and to dive in, to make sure you don't say something to a buyer that's insulting, because you're like, why are you asking me these questions? Hold on a second. Let's follow the rules. Let's get somebody beside me, get an intermediary here, make sure I'm making good decisions. It's not easy. So come to grips with that before you enter this. And we'll talk. We got a story later, but make sure your number's your number when you go in, and what that's all these tax sessions and everybody leaning into you guys. They want to invest in you because we all want you to be successful. You want to be successful. So, it's something that you have to have, and you have to have a vision for yourself after you're done. What are you going to do when you're done? Right?
Mm-hmm. Yeah. Darcy stressed that point. Have a good story of why you actually want to sell your shop.
Absolutely.
It's important. The buyers care. Just like I said a little bit earlier, if you tell a buyer that you're selling it because you're burnt out, why do they want it? They don't want it. It's like, but and it's just, it is. You got to understand why it is. I've taken it to this level. I'm taking money off the table because, this is a big part of my overall investment. And when Dave alluded to the red light, green light, this is something that I think helps to simplify it for you listening as business owners, because what I'm referring to is know where you need to be for price and terms. Right now, if you haven't talked about it before in these seminars today, terms are actually a lot of ways more important than the price in some ways, because if someone's going to give you 90% of what you want right away and 10% with a seller note later on, that's much better terms than if you get 10% down and 90% over the next 10 years, in a seller note. You get paid over time for the next. So you really got to understand where you're at in that spectrum of, and your M&A professional, if they're not the right one, but they should be helping you through this and understanding that. You go, okay, my price is $10 million. I can't go below $10 million. And I need to have terms like this. I must have a seller note of less than whatever it is, 25%. So that means I have 75% minimum down. So I get $7.5 million down and $2.5 million over time. So when you're getting through all this diligence, because as Dave talked and Paul and the other people earlier today, that diligence is just, man, they are going to ask you questions that you never even thought about yourself in your business. And it's going to be frustrating. But when you can boil it down to, am I getting the money that I want? My red light, green light. If I'm below that, I'm not going to go I can't do it. If I'm above it, hey, I'm okay, and I'm going to go. And that's what it simplifies it, because it is such an emotional process. They will ask you things inevitably you're going to go shake your head, could make you very angry, all kinds of stuff that's going to happen. But keeping that red light, green light line where you want to be helps to make a clear decision as you go through it. Because if you don't, it can cause a lot of problems.
Yeah, I'll tell you, this is stories learning and takeaway. Recently, we had a buyer showing up, and it was a partnership. It was a partnership with two gentlemen. And the day the buyer was showing up, the one partner was like, you know what? I don't want to sell it. I want to buy it myself that day. Because after that question had been dealt with for a long time, it's like, you got a week, mister. And then we had another one that had an LOI. Say, hey, this is my red light, green light. My red light, green light is this number. Let's call it $5 million. And then due diligence starts, and he finds out, wait a minute, my business is worth a lot more than $5 million. Now I want 6. And the buyer's like, no. We see so many things that people. You got to know what your red light, green light is.
Yeah.
You got to stick with it, and you got to have that conversation beforehand. Otherwise, you'll put the whole deal in jeopardy, because the last thing an investor wants is an emotional, unstable situation. Because if it turns emotional unstable, it's not a deal that's really scalable for them and winds up being a lot of trouble. Right?
Yep. And they will run like the wind when they hear that. And you have that. We had a client a couple of years ago that went from, man, I want this much. And then pretty soon you realized it was worth a lot more. Okay, so that was before we were at market. We went to market and found out that, okay, we had the red light, green light. It was set up. And they were like, well, I talked to my buddy and he thinks it's worth a lot more than this. And we're like, listen, there's 6, we vetted this in the market. There's 6 people that said we're all within about this much on the price. Mm-hmm. It really doesn't change much more than that. Well, go back to them and ask them for more money. And we did it once. You might get away with it for a little bit, but it drove the deal to an end because they just kept getting more and more demands on it instead of just going, hey, this is a good amount of money. I'm happy with this amount of money. We talked about it, and then we're going. Because what that forces you to do is go back through that entire process again.
And at the end of the day, Damon, that's why you need somebody, whether it's us or somebody else, you need somebody to build yourself as sustainable with plans, and you need a good broker that's going to analyze your business and tell you what it's worth, so you don't make those last minute changes, because that can hurt, right?
Yeah. Yep.
So we have a few questions, guys, hopefully, and we're just about out of time. I think we can go a little bit over. That's no problem. But John asks, how do you deal with a bad month or negative change during due diligence?
I mean, Damon, I think you have to have a story around it.
You got to understand what it was.
Usually buyers look at averages. They look at the last 3 months, last 6 months, last 12 months. And I mean, some smaller shops are pretty choppy, right? Sometimes you have a high month, sometimes a little lower, and they average it quarter over quarter. So if you have a good story putting around that, you ask your trusted advisor, hey, this is where I'm at. This is the truth. Whatever you do, don't lie, don't be misleading.
Yep.
But if it happens like every September, you have a low September because this, that, and the other. I mean, HVAC companies deal with this all the time.
Yeah.
You just
Great
need
point.
storage on it, right?
Mhm.
Yeah. The other thing is, don't think about the impacts of your decision, because this, I can't believe you guys brought this up because it's so good. We had a client last year that actually decided that one of his divisions wasn't running really well, but it was creating revenue, right? And he shut it down. Okay, well, that wasn't so much when you go, if I'm running my business for a long time, that made a difference. It dropped stopped production for a while, and it dropped the value of the business by $1.3 million. And because it was stop, and then I start and build back up again over time. It was just wasn't working right. And we're like, and so he got below his red light, right? He wasn't able to get the money for the business anymore. So you really need to understand these decisions as you're making in that part of your time.
Right.
Great. Another question here. What did the COVID bomb do with evaluations?
Well, we saw both. We saw people doing work for like Boeing and certain companies that really slowed way down. Some elective surgery companies, they slowed way down. And so, but they had longer term contracts. So they were okay. They just had a low 2020. Now, some different buyers will let you exclude a certain group of time in COVID, because you can add what they call a COVID efficiency EBITDA add back, or there's other ways to kind of get around that and say, hey, this isn't normal. We do have contracts in play. COVID did impact certain businesses. Machine shops, I mean, thank goodness, weren't impacted as bad as a lot of other shops or a lot of other businesses. Mm-hmm. But as long as you have a story and you have some long-term contracts, COVID didn't affect a lot of people.
Yeah. And we had clients too that had terrible COVID impact. I mean, for a quarter. And really what we did is, once we saw the growth coming back again and back to normalcy, we just excluded it. We just said, listen, everybody knows what was happening, right? Mm-hmm. But they also were in the kind of markets that shut down and turned back on. You know, the aerospace is taking time. You'd have a hard time convincing a buyer that that's going to be back to normal anytime soon. Right. So it really is industry dependent.
100%.
And then last question here, and we'll move on. Are you able to value on the next 12 months in a growth situation?
Do you have a previous 12 months to show that it's a growth situation? So if you, right, Damon? So if you have, and you look back 12 months and you see this trajectory going up like this, you can forecast, if you have some long-term agreements in place and showing that work's coming at you, you can totally forecast that. And really, yes, it does. I think it can impact the purchase. Don't you think, Damon?
Oh, it definitely moves it up. You won't get the full value, but you can get some of that value out of it. But, Dave, you hit it so critical. If you're sitting here today and I just got a new contract and I'm just starting to produce on it, really haven't seen revenue over time, you're not going to get anything. Let's just be realistic. Yep. But if you do have that growth trend and it's going on it, you're going to get part of it. And you're also, as I mentioned before, you're going to create that anxiety or that anxiousness in the buyer that they're going to want to get it before the value is gone or before the value gets higher.
Yeah, once you have a sustainable business where an owner can sit home and your business creates revenue, and then you sit back and you lean into the data and you have good data stream that tells you where your company's going, that's where magic happens. And you'd be amazed what you can sell a company for, because there's a lot of money out there that they want good companies like yours, right?
Yeah.
Yep.
And you said it, Dave. If you got like the systems that you put in, or like we're typically working with, you have to have that showing the historical and moving forward where you're going. Because if you're, it's so key. So key. The better they can see that, the better you're going to be able to project your value.
Paul, do we have to stop? This is so fun.
Yeah.
You know, I really want it to be an all-day event, but we cut it back because people only have so much bandwidth to sit in and watch a screen all day. But thank you guys so much. I know that was super valuable. Hopefully folks got a lot out of that. Thank you again so